Craig, Barry, taxes, as we've talked about, often come up. What are the issues you see in taxes?
Hopefully you've been through this process already in the planning stage. Just in case you haven't, I guess it's quite important that you understand before you actually sign on the dotted line, you actually understand what your income tax obligations are, for example. So you might have a capital gains tax bill that might trigger, when that money might be due. If it's part of a vendor finance arrangement or subject to earn-outs or instalment payments or things like that, you might find that part of the proceeds may be received down the track, and sometimes those proceeds might be received after your tax is due, for example. So it's making sure that you understand what tax is due, when it's due, when the proceeds are coming in, and working out how much do I need to put aside. And so it might well mean that you have to put aside a larger amount up front on the assumption that you'll be getting further proceeds down the track. Things like GST potentially come into play. So if you're selling a business, particularly the assets, you need to consider things like whether you fall under the going concern provisions and things like that. So usually with a business sale, you'd expect to, but it's not always as cut and dry as that. Division 7A, which is a provision that deals with companies making loans to shareholders and associates, can come into play, I guess, on two angles. So I guess on the one side might be if you are providing vendor finance, just depending on how sort of previous arrangements have been run, particularly with internal people coming through, you might have already provided them some sort of arrangement as a retention strategy. So they might be already shareholders of the business, but might be moving from being a minority to being a larger stakeholder. You may trigger a Div 7A loan, which can have quite meaningful consequences in terms of the amount that they have to repay back to the business over a period of time. So understanding what the implications of those are is quite important. But I guess on the flip side is if you're an existing business owner, you might have existing Div 7A loans within that business. And so I guess part of this strategy and part of a due diligence process would be to look at, well, as a person coming into a business, you probably don't want to inherit those existing Div 7A obligations. So working through what strategy might be to tidy those up if possible. And then there's obviously transfer duty, which Craig's probably in better position to discuss.
Yeah, so look, transfer duty will mostly kick in when we're talking about an asset sale, but it is really important that you do look at exactly what is going on, because there are other little niches where transfer duty can crop up. So for instance, if you are dealing with trusts, so if you have, say, a unit trust that holds a business and you're transacting the units, people that are used to transacting shares will just think, oh, well, I don't pay any duty. Now on unit trusts, if the unit trust owns dutiable assets, you transfer the units, you'll pay duty as though you were transacting the assets themselves. So that's one that can easily just crop up and sometimes catches people unawares. So it's one of those things you really do need to look at early.